Let's just talk about Venezuela. Venezuela has more proven oil reserves than Saudi Arabia. That's a lot of oil, but they only produce out of those reserves about 0.8% of total global oil production. So they don't even move the needle in terms of that. However, oil prices are a function of supply and demand. So the bet you've got to make, so energy companies have been rallying really strongly for the last couple of days on expectations that they're going to be able to go in, help Venezuela start to reconstruct their oil production, get their oil production up, start to generate a lot of wealth for the country. That's great for Venezuela, but that would potentially bring a lot more oil production online, which would potentially suppress oil prices. Again, the question becomes, do we get too much supply of oil in the market, and does that suppress supply of oil? Now, just technically on a short-term basis, oil is pretty oversold. I would not be surprised to see some type of event occur, that maybe something in the Middle East that potentially gives you a threat of a constriction of oil supplies and you get a pop in oil prices. Something cut production, absolutely, and that would give you a pop in oil prices, only because oil prices are very, very oversold. But kind of my running thesis right now, for clarity's sake, we have some energy-related positions in our portfolio right now, but those energy-related positions are more attached to AI power generation than they are oil production specifically, because I think oil prices have a bigger risk of going into the 40s than the 80s over the course of this year, just on a risk basis. I think there's a potential risk there that we see lower oil prices over the next 12 to 18 months versus higher oil prices. Again, complete guess. You don't know what's going to happen. And again, if OPEC came out and said, you know what, we're going to slash oil production, oil prices are going to jump.
So do you think that's a function of economic activity, more or less?
Yeah, oil prices. So oil prices are tied very closely to two things, inflation and economic activity. So if you overlay a chart of oil prices to GDP, you get a pretty decent correlation. Same thing for inflation. You get a pretty decent correlation with that, because oil is used in everything, right? Yeah. It's everything that we use, produce, consume. Oil's involved in that. So it really is a reflection. If we do get slower economic activity, slower rates of employment, then I think oil prices. Again, if employment slows, less driving, et cetera, so you get lower oil prices.
So do you think prices as far as oil stocks are maybe getting out a bit ahead of themselves, considering we don't know exactly what's going to happen?
Energy stocks have been detached. If you go back and look at XLE and overlay XLE to WTI crude, they used to have a super high correlation. Over the last couple of years, they've been very detached from each other. And there's a couple of reasons for that. There's been a lot of speculation in that sector, but that's also kind of a function of market dynamics. But oil is the input into their bottom line of earnings. What's happening with oil is what happens with their revenues. So the question is ultimately, does oil catch up with energy stocks, or does energy stocks catch down with oil?
Catch me daily on The Real Investment Show. The link is in the description.